really getting back to the basics, these are the 5 things that we're going to talk about. Number 1, know the rules of the game. Number 2, understand that banks are not created equally. Number 3, understand that you have choice. Number 4, don't overstretch yourself. And number 5, give yourself enough time to submit an application. Let's dive into it. Okay, number 1, know the rules of the game. So when a bank approves or declines your loan, that decision is not made randomly or arbitrarily. There is actually a framework that gets applied to evaluate your loan and approve it, as well as a framework and a method to get a loan approved. So you might ask, what is this secret sauce or secret formula? This is known as the 5 C's of lending. Irrespective of whether you're going for a residential loan or commercial loan, the 5 C's of lending or 5 C's of credit will always apply. The first C is known as character. So this is all about, are you an eligible borrower? Are you of legal age? What is your borrowing history? Are you an Australian citizen? Do you or do you not have a criminal record? This is important to look at and evaluate your character, and this is the first thing that any lender will look at. Number 2 is your capital. So this is your contribution in terms of this is your contribution towards the asset that you're buying or investing in. Capital can also be known as your equity or your deposit, and it's one way the bank looks. It's one important thing that a bank or a lender looks at to make sure that it's safe for them to lend you the money. Number 3 is collateral. This is otherwise known as security. In Australia, collateral is mainly property. Banks treat property as their preference for security, but really security can come in many forms. If you're buying a vehicle, obviously it will come in a car or a truck. Cash or a term deposit can form security. If you were lending to a friend, security could be anything. You could take their, I don't know, you could borrow against their Bitcoin even if you wanted to get extra creative in coming up with collateral or security. Number 3 is capacity. Another way to think of capacity is your cash flow or borrowing capacity. So this is what income you have left over after all your expenses to service a loan. And this cash flow comes from either you going out into the marketplace and working and generating an income, or you having purchased investments which are generating cash flow for you. So this is what determines your borrowing capacity, and capacity is an important part of the 5 C's of credit. Finally, the conditions the bank offers you. This is the final C, typically coming in after they've checked off every other of the 5 C's. So this is about what interest rate you're getting, the loan term, the type of repayments, whether they're principal and interest or interest only, and also any requirements you need to meet before the bank giving you the money. So importantly, these are the 5 C's of credit. Know the rules of the game. And whether you're borrowing from a friend or buying a really nice house or commercial property, these rules will always apply. Okay, moving on to number 2. Understand that not all banks are created equally. You should shop around to see what is the best deal available for you, not just in terms of interest rate, but in terms of loan amount as well as terms. So to take a look at this, let's actually look at a real life example from a client of ours who we've made anonymous by changing names, facts and figures. But the key takeaways from this case study are very relevant. Okay, so we have an IT consultancy business based out in the Ryde Macquarie Park area. So it provides IT solutions, sells hardware, sells software to his clients. Very important now when everyone is working remotely. And he came to us to buy a house. This is what his profit and loss looked like. So I'll just turn on my laser pointer. Okay, so you can see he's making good income in the top line across the last 2 recorded financial years. However, when you take a look at the profit line, the previous year was a lot less than the most recent year. So this is because our client had a sickness in the family, and a lot of his time in the FY18 financial year was attending to that family member. So he got really taken out of the business. Now, in terms of this profit, this client then pays himself a salary or takes a drawing from the business, and where there's some surplus, he puts the rest in a beneficiary company, or what's known as a bucket company for distributing dividends. Okay, so that's his profit and loss. In terms of his balance sheet, reasonably strong. We can see a commercial property in there. We can see some cash which he had available to put towards the new purchase. And then we can see he has a liking for vehicles, and so has a couple of motor vehicles in his business. Now, where you see assets, you will often see liabilities, depending on what those assets are. So for this client, he did have a mortgage against the commercial property, as well as some asset finance, which means in servicing, a lender may require you to disclose and factor in those repayments in a servicing test. So to test their borrowing capacity, to test their cash flow, you need to understand what their commitments are. Okay, so we then ran these numbers through our panel of lenders, initially with a focus on major lenders. And let's see what each bank came up with. Okay, so CBA and ANZ, we know them and their policies very well. They're able to take the latest year's income. And with taking the latest year's income, obviously that was reported at a much higher figure of over 500,000. And so the client's borrowing capacity was comfortably over $2 million. This is a great outcome, and it allowed the client to hit the purchase price that he was looking for, which was roughly 1.8, 1.2. Now, next along our lenders, we look to NAB and Westpac, and their policy is to average the last 2 years of income. And so when you average the last 2 years of income, you get 362,000 rather than 543,000. However, now the expenses really start kicking in and dragging down borrowing capacity as well. So borrowing capacity at NAB and Westpac, where it was over 2 with ANZ and CBA, ended up between 1 and 1.1. And this slight difference is because Westpac allows you to exclude loans in the company if you're taking all the profit out of it. Now, looking at the furthest end of the spectrum, some lenders don't like a big jump in income. And so where you see a big leap, they will cap your prior's income by 120% of the previous year. So in this case, 120% of the previous year was 216,000. And a lender that does this, for example, as standard policy, you can request to waive it, but as standard policy, it's only 120% of the previous year. Doing that, you get 216 and only 950,000 of borrowing capacity. So imagine rocking up to an auction and considering only your existing bank, and you want to bid on a $2 million property, and you win that property, and then finding out that your bank can only offer you $950,000 or $1 million, you're up for a deposit of $1 million, which can be a big shock. So before you seek a pre-approval, before you look to purchase a property, make sure you understand that not all banks are created equally, and it's very important to shop around. Okay, tip number 3 is to recognize that as a business owner, much more than a PAYG employee, you have choice with respect to your lenders. So with business lending, there's pretty much a type of lender for every business need. And there's a lender depending on your type of business, where your business is at, the purpose of the funds, the type of assets that you're buying, even how much work you want to put into the deal to get an approval or the best outcome. There's a type of lender for everything in the commercial world. And really where these lenders sit is a matter of risk reward. So for most of the audience, bank lending is where you would know. You'll see bus ads, see them on radio, see them on TV. And so bank lending is where the bulk of our clients would, or the market would be familiar with, because that's where all the marketing dollars are spent. So the thing to know about banks, they will give you the best rates. However, they also, because the interest received by a client is their reward, they will give you the best rates, but they will take on very little risk, which means out of the 5 C's, all those 5 C's must be optimized, and they will look into detail, and a lot of detail, into your paperwork to make sure you get the loan before approving the loan for you. So bank lending is, I guess, the starting point of this risk-reward spectrum. Along the curve, you have non-bank. So these are lenders you may be less familiar with, but are also very large, either listed companies themselves or even backed by very, very large private equity firms and other financial institutions. These lenders are willing to compromise on something to give you the loan. Maybe it's the paperwork, maybe it's maybe it's the paperwork in terms of how current it is, or the type of way you're proving your income. Maybe it's your duration in business. They're willing to trade off something to give you the loan, but of course, for taking on that risk, they ask for a little bit more reward, so the rates go up. These lenders are primarily broker introduced, so they don't have branches or mobile lenders running around. You will need to see a broker to access non-bank lending. Next on the spectrum is lenders, which probably the more advanced borrowers in the audience would be familiar with. So these are lenders which give the most weight to collateral. So they all will lend on the basis of taking a first mortgage and having a very good security. They also require a lot of equity in the deal. So you need to have put in quite a bit of cash to make it healthy, typically 65%, typically 30 to 35%. And they all want to know how you're going to pay the loan back. These loans are only of a short-term nature, usually 12 to 18 months, and they want to know how you're going to exit the loan, whether through a refinance, a recovery of the business, and then switching lenders, maybe selling the security, or finishing a property development and selling all the units to pay back the loan. On the final end of the spectrum, we have very specialized lenders for all different types of purposes. They may be fintech lenders, which have emerged today, such as Prosper, SpotCap, Banjo, OnDeck. They are not even on this diagram, but they're lenders, the fintech lenders that exist. They can offer unsecured loans. So where I mentioned in Australia, there's a preference towards property. They're able to give you a loan on the strength of your cash flow balance sheet. Or they may lend against very specialized security. So for example, a strange piece of equipment or specialized piece of equipment you might be importing in, maybe something that is secondhand, maybe a unique fit out that is special to your business. This is the final end of the spectrum. And of course, because they take on the most risk, you are paying the highest interest rates with these lenders. So yeah, it's a matter of risk reward and how much work you want to do. And as an example of this, I'd like to introduce everyone in the audience to something called alt-doc or specialist lending, which sits in tier 2 in the non-bank space. And this is a type of lending where the rates are a little bit more, but it might offer you a solution if your paperwork is not ready, as well as a much smoother process to get a loan. So what is alt-doc lending? In residential, at least, you do have commercial versions as well, but in residential, typically loans up to $1 million, where you self-declare the income that you earn to service the loan. Now, because the lender takes on more risk with you declaring the income, they don't need to see your financial statements. They are more conservative with the security that is accepted. So typically it needs to be metro security. So I guess within the closer to the CBD, you know, in the main rings of Sydney, Melbourne, Brisbane, that sort of thing. And to compensate for the risk as well, they do charge typically a rate of about 1% higher, as well as a risk fee or an establishment fee of 0.5% to 1%. Now, with this type of lender, you can't just say your income. Your accountant needs to support with a corresponding letter, which is a template letter that the lender provides. So you can see here in this final part, the accountant is also endorsing the income that you earn and needs to sign this declaration to for you to get the loan. So while it's relatively easy from substantiating your income, you really need accountant support. So this is one solution, as well as other solutions available to business owners. Definitely recognize you have choice depending on where your business is at, the status of your financials, and how much work you want to put in to get the loan. Okay, tip number 4 is not to overstretch yourself as a business owner when going for a residential or commercial property. So this is, you really need to know what deposit is required for any type of property, as well as be comfortable with the repayments associated with that. So what we'll do is we're going to look at what it takes across a residential or commercial as opposed to a commercial property. Okay, so for a standard residential, and this applies even if you're not a business owner but just on PAYG and earn a salary. For standard residential, let's say you're buying a $2 million property. A maximum LVR of 80% is very common. So LVR stands for loan to value ratio. This is the value of the loan with respect to the property. And in this case, an 80% LVR, 2 times 80, would allow you to borrow 1.6 million. So that would be the loan that you need for a $2 million property. Now, if you're borrowing 1.6 and the property costs you 2, then you need to put in 400,000 to make that purchase work. So 2 minus 1.6 is 400,000. And no matter which state you go to, stamp duty applies, especially at this price point. And the stamp duty in New South Wales is around 95,000 for a $2 million purchase. So if what that means is you don't only need the deposit, you also need the transaction costs, which means a $2 million property at 80% LVR is costing close to 500,000 in terms of the deposit you need or the funds you need to settle that property. So that's the deposit. If you, in terms of the repayments, rates are pretty good right now. Let's just assume a rate of 3.5. So it could be home lending, it could be investment. A $1.6 million loan at 3.5% over a 30-year term is a repayment of $7,185 per month. So this would be your monthly repayments that you would need to keep in mind for your own budgeting as you evaluate that purchase. Now, for residential property, there are instances when you can borrow more. So if you qualify and if you desire, you can borrow 90%, which takes the loan up to 1.8 million. So the bank will give you another 200,000. However, 2 things start happening. An extra charge will be introduced called lender's mortgage insurance. So this is an extra charge designed to protect the bank if something goes wrong with the loan and the property is worth less. And also, because you've borrowed more, you're now borrowing 1.8. At the same interest rate, of course, you're borrowing more and have the same time to pay. So the repayments will go up roughly $900 a month in this example. Yeah, so this is something you can do in residential, but in commercial lending, LMI does not exist. There is no concept of LMI. So let's actually look at the cost breakdown for a commercial property, also worth $2 million, okay? The first thing to note is for commercial, while the stamp duty is the same, the amount that the bank will lend to you drops substantially. So a standard commercial LVR is 65%. Now, this is standard. I put an asterisk because you can borrow 70, 75. I would say 75 is the maximum for most borrowers, unless you are of a certain profession, namely a medical professional. Typically, 65 to 75% is the range of the LVRs for a commercial property. I will do all our calculations on 65% just to keep it consistent with the market. Now, for commercial property, there are some extra charges on top which you need to be mindful of. So if you buy the property with vacant possession, so you want to occupy it, or there's no tenant in there, you do need to pay GST upfront on that property. So GST is something you need to pay upfront. You will get it back, so your net outlay will be reduced by 200,000 once you get it back. But at settlement, you need to be ready to pay GST. And of course, 10%, GST in Australia is 10%. 10% of 2 million is 200,000. In commercial, banks also pass on to you the extra costs, the extra transaction costs to complete the transaction. So mainly any legal fees or valuation fees, they will pass on to you. And lenders can also pass on or charge you establishment fees for the extra work involved to get the loan in place. So in this instance, I've estimated roughly 1% of the loan size. And so you can see that not only do you need a bigger deposit, but your transaction costs at settlement can be very large. So to buy a $2 million property, you do need close to $1 million if it's vacant at that time to purchase this property at standard bank policies. Now, this is standard bank policies. We can find ways to work around that, but these are the sort of figures that you need to keep in mind. Of course, when you get the GST back, it'll drop to 807 in terms of your total outlay for that property. Now, the next thing to note for commercial property is that where in home lending, 30 years is very standard. In commercial lending, 30 years is not standard. 15 years is for a P&I or term loan that is reducing is a much more common loan term. And this means even though you're borrowing a smaller amount of money, so we went from 1.6 to 1.3, you have less time to pay back a smaller amount of money. It's still a larger cash outlay every month. So if you were to pay back this loan principal and interest, then the repayments would be $9,293 a month. So this is why often business owners will opt for interest only, or maybe even consider a non-bank lender to stretch out the loan term, because that can drain a lot of the cash flow out of the business. But it is important to keep these things in mind. So the smaller LVR and the shorter loan term when purchasing a commercial property. Now, for commercial, there are a whole bunch of different types of properties. So usually in residential, you have an apartment and you have a house. But in commercial, you might have retail, you might have industrial, which has factories, warehouses. You can have offices, you might have a pub, you might have a hotel, you might have a motel, you may have a childcare center. There's all these different types of securities out there for commercial. Where a security is very specialized, then that LVR can reduce. So say you're buying a petrol station which has issues such as contamination, or you really need to remediate the area, LVRs can be as low as 50%, which means that your contribution up front has to be quite substantial to access that property. And so this is just an example. Each lender and each security and each client will have its own unique LVR, but these are things to definitely keep in mind when buying a commercial property. And you can see here, you get a whole range of different outcomes, even though it's the same purchase price. Okay, that was tip number 4, know what it takes, don't overstretch yourself. Tip number 5 is to start early. Give yourself enough time. Now, this is especially my advice if approaching a bank. So what I'm going to show everyone is this is a real example from a real email one of our bankers sent to me to pass on to a client. And he listed out everything that he needed to get the loan approved. If you can't read this font and it's very small, that's intentional because there's a lot there and it's very detailed. So my job and the job of my team is to manage this for business owners and simplify this so that they can make decisions rather than be distracted by the detail. So this is a long list, but if I was to break it down simply for everyone, they want to know how your company has been performing historically, as well as the most recent figures, even if you haven't got the financials ready yet. So rather than forecast FY20 is now closed, they want to see your draft P&L for FY20. Next, they want to know how your company is structured. They want to know that the numbers that you're showing them are true and correct. They want to know if you have any sort of funny loans or behaviors going on in your company financial statements, whether in the P&L, the profit and loss, or the balance sheet. And they want your accountant to certify all of that. Okay, next they want to know what you're earning from the business personally, as well as a complete look through, complete transparency on the cash flow of the business itself, as well as any commitments that you have. This includes tax commitments, guys. So they do want to see if you're up to date with your taxes. Often in a bank, a ATO liability can kill a bank deal. So it's really important to have current to have current tax portals and be on top of all your BASs, PAYG installments, any sort of taxes when approaching a bank. You will not be able to hide if you have taken out a loan, any loans, and you do not disclose it. They will request the business transaction history and in some cases your personal transaction history to see what commitments you've taken on. On top of that, a banker would ask you to fill out the application form, which can be quite lengthy and time-consuming. Now, we do this for all our clients on their behalf, but they also have an administrative requirement to fill out the application form and collect, of course, your ID, the contract of sale you're purchasing, as well as the trust deed if that's how your entities are structured. Okay, so for this email, we were committed, say, 2 to 4 weeks to get an approval. I will warn the people in the audience that this is actually a quick time frame. I'm seeing more, not 2 weeks, but up to 2 months to get a loan approved. So it's not just gathering the paperwork for the banker to then review it, piece it together, recut it for credit, and then for credit to go through it, and then for credit to ask their questions. This can take quite some time. So be ready if going to the bank for funding. Give yourself enough time. Okay, so those are my tips, guys. Really simple stuff for those new to business lending. Know the rules of the game, know the 5 C's of credit. Number 2, understand not all banks are created equal, so definitely shop around to get the best deal. As a business owner, number 3, you have choice. So understand risk reward and match your lender choice to how much risk you are willing to present to the bank, as well as how much work you want to do. Number 4, don't overstretch yourself, know what it takes. And then number 5, give yourself enough time. Please start early if you're considering purchasing a home or a commercial property as a business owner. Okay, we're going to shift gear now. I will remind everyone, okay, so we're going to shift gear. We're going to do a business lending updates, how lenders and banks have responded to COVID-19. I will remind everyone, we do have an option to field some questions at the end. So yeah, feel free to drop your questions in and I'll answer them right at the end. Okay. Okay, so for this business lending update, we're going to go through 4 topics. Number one, the $250,000 small business loan. What was it? What happened there? What were the bank's responses to this? Number two, what are banks looking for during COVID-19? So what's in favor, what's not, who are the winners and losers? Number three, enhanced due diligence. So what extra questions are banks asking, and what extra paperwork do you need to provide to get a loan? And then number four, policy changes and their financial impact. So we'll actually look at some policy changes as well as some facts and figures to see how you as a borrower or a property would be impacted in response to how lenders have changed their requirements. Okay, number one. So when coronavirus first hit, the banks really responded in two ways. They were trying to act as shock absorbers in the economy. And so they offered, first and foremost, loan deferrals. So this was the ability to pause your loan and suspend repayments completely for 3 to 6 months. So we want to talk about loan deferrals, sorry. But the other initiative that they introduced was small business loans of up to 250,000, and these were initiated by the government to distribute via the banks. Okay, so when these loans were announced, they were very appealing to business owners, and they were really marketed and positioned as, at least by the government, as an option to sustain a business during coronavirus. So these loans were meant to be, or they are, unsecured. So you do not need to put up security. You do not need to offer your house to get the loan. They would offer very competitive interest rates. So 4.5% for an unsecured loan. You saw our diagram, those rates are usually in the teens. For an unsecured loan, 4.5% is very competitive. They would offer 3-year terms, which is reasonably short actually, but there would be no loan repayments for a 6-month period. So loan repayments would be completely deferred on this type of loan for 6 months. Being government backed, they were perceived or viewed to be easier to approve and quicker to approve. That was the belief in the marketplace, at least. And of course, we all thought coronavirus would be over come September, but you know, we do definitely live in interesting times. The end date for these type of loans in terms of getting approved was going to be 30 September. So this was sort of the package or the offer available. Now, what happened in reality was clients, as well as our bankers, had a very frustrating experience administrating these loans. So first and foremost, they were inundated with requests. They received a lot of requests, not just for loan deferrals, but business bankers received a lot of requests for these loans. Now, because of that, and because of the uncertainty in the environment, bankers had to prioritize existing clients. So if you were a CBA client, you couldn't go to Westpac, where if you didn't bank there, to apply for one of these loans. So you had to go to the bank which you bank with to even request this loan in the first place. Also, many business owners misunderstood the purpose of this loan. So this loan was to pretty much tie over a business or support a business's cash flow during coronavirus. So where income had slowed down or stopped, keep staff on the payroll, pay for some running costs of the business to keep it running, basic working capital needs of a business. That was the purpose of the loan. But many clients applied for startup funding, so they wanted to start up new business areas. They thought of using this loan for business investment, so starting new business lines, buying certain types of equipment, pretty much not sustaining the business, but trying to venture out into new things. And then there were business owners that even applied to try and rescue or resuscitate a dying business. And this was a business that was already failing or not doing well prior to coronavirus. Pretty much these bankers just knocked these requests back after a few basic questions. And then finally, the servicing tests were really hard. So these loans were, the servicing for this loan was tested on your old figures, so your FY19 financial. So how did you trade in a normal environment, if you will? And if you do the maths on a $250,000 loan at a 4.5% interest rate with 2.5 years to repay, it's over $9,000 a month to repay that loan within a 2.5 year period. For many small businesses, and especially those that were just hit with a lot of unknowns and a lot of uncertainty, $9,000 a month is typically a lot to pay for a small business. So what we found in experience, we actually managed some of these loan applications for clients, and we found that we'd ask for 250 and maybe 100,000 would be approved. And even some of these applications just didn't go ahead because they met the wrong loan purposes, or the paperwork just wasn't hanging together to get the loan. So that was what happened in reality. But there is some silver lining, because last month in a Treasury update, Josh Frydenberg made an announcement that this scheme of government endorsed loans would be extended, as well as increased to up to $1 million. So that's a very generous size for a lot of small businesses. That's probably a lot of a loan size that many business owners wouldn't even know how to invest that if they were given that type of loan. But it does make 250 a lot easier. And also the new extension of this initiative would have more relaxed policy. So these very strict or standard criteria in servicing and very strict responsible lending requirements would be more relaxed for these next batch of loans. Now, we don't have that much information on them now, but stay tuned. We will definitely update our clients if we hear more. Okay, moving along. I know we've got 15 minutes left, so we'll move along quite quickly to get to the finish line. What are banks looking for during COVID-19? So there have been winners and losers during this period. What's in favor? So there definitely have been industries that have done better in this time. So these are logistic companies, technology businesses, healthcare, cleaning businesses, businesses in wholesale food manufacturing or distribution. They've done really well. And linked to these type of industries are industrial properties, so warehouses and factories. So banks have seen a greater inflow of industrial property applications, especially those, especially of an owner-occupied nature. So basically, a business owner not wanting to pay rent anymore, wanting to own their property outright. They're also looking for experienced business owners. So people have been in the market and run their business for at least 2 years. That's typical bank policy. They also want to see clients who have ongoing cash flow. So they haven't been if they've been impacted, there is still income running through. And ideally, they also have a strong balance sheet behind them. So savings or equity or liquidity to see them through coronavirus. Okay, and no loan deferrals or adverse history. So if you've got late repayments, banks aren't that interested in helping you. Loan deferrals and adverse history are really negatively viewed in banks. And during this period, they want to see that you have a strong COVID plan. So what has been your strategy to manage and get through this period? Okay, in terms of unfavorable, basically any industry impacted by social distancing. So hospitality, retail, tourism and travel, education, accommodation, these are not viewed very well right now. It doesn't mean you can't get a loan, but just not viewed well. Retail has been hit, B-grade offices. If you've been in the city, it's really quiet out there. Investment property. While an owner-occupied purchase, the business owner needs to be there. Investment properties, if times get tough, those owners can sell the property. So there's more risk to banks. So investment property is less favorable. Inexperienced operators and startups. So this is out of favor, this is out of favor as well, guys. Now, it's important to know that often a new business tries to go to a bank for a loan, even to get that business started. Banks are not the place for startups unless you are already an experienced business owner. It's a common misconception that the bank will fund a very early business. That is better for those funding needs. It's better to look along the spectrum, or you need to find some equity to fund your business. Okay, cash flow. If your cash flow has stopped, it can strike you out in a bank, and especially if you've got, on top of that, poor liquidity or no savings to get you through this period. Unfavorable loans on deferral or in arrears. And if you have no COVID plan or no way to adapt to this market, then yeah, banks don't like that either. You won't be able to answer their questions, which is what we'll get to next. Now, if you are in one of these industries, doesn't mean you can't get a loan. It just means you've got to explain things a lot more. And each scenario is case by case. And so you need to talk to us or a banker to really understand the business and your options. Okay, we've got 10 minutes left. That should be enough time. Okay, number 3, enhanced due diligence. So what are banks asking or looking for in terms of questions and paperwork? Now, the question on every banker's lips, and their first question for you will be, how has your business been impacted by COVID-19? And they're looking at this in a number of ways. So you may just have a simple questionnaire where you can say, no, I've not been impacted and all things are fine. This is probably the simplest thing. And if you say things are fine, no questions asked, but if you say you're impacted, then you do have to explain. By default, if you go to a bank, banks will ask more detailed questions, and they look like this. How has your cash flow been impacted? What actions are you taking to preserve cash flow? Is there opportunity to diversify or pivot the business? Is there a reliance on any other industry to supply goods and services? And how is this impacting the customer, or that's you, the borrower? And are there any alternatives? And does the request make sense given the current environment? So they really want to know your strategy and how you're managing. And of course, I mentioned there's winners and losers. So many businesses, whether because from the sheer need, have actually, if they haven't totally benefited, they have pivoted to this environment. So often a restaurant, for example, will really start drawing up their takeaway business and offering takeaway offers to get through this period. And of course, there's a difference between, say, a CBD restaurant, which I've personally found a bit more quiet, versus your local restaurant or cafe. I found local cafes quite busy during this period. So you really need to explain how you are performing during this period. Some lenders are even asking you to fill out what's called a COVID impact statement. So they're putting these questions in a form. We would typically help a client complete this and write a statement, which we then verify with them and get their endorsement to the lender. So same types of questions, write your impact statement. What are your contingencies? What are your fixed costs and how are you managing them? What cash reserves do you have? So what's your ability to survive and sustain yourself during this period? Now, in terms of additional paperwork, whether you saw from that long list before in a bank, you really got nowhere to hide, but even low doc, they're asking for more information. So this information sheds light on your liquidity, your savings, and your cash flow. And so the types of documents that banks are asking for, June BASs, they want to see a draft of your P&L. So, you know, in the height of coronavirus, how did your business sales perform? How did you go in the 12-month period where you did have some impact? Let's actually look at your account statements to see the cash flow coming in and what expenses. And when they see your trading accounts, they want to see, are you in arrears? Are you late on any payments? Did you defer any loans? Is there income coming through? And what is your savings to see you through this period? So that's where the trading statements come in. Okay, last but not least, we'll look at the policy changes that banks have introduced. So when the pandemic first came and made its, really disrupted the Australian economy, banks really scrambled to make sense of how to respond, what was the impact of businesses. So they were inundated with not only those small business loan applications, but also loan deferral requests. So this meant they were just completely overwhelmed. That was the sentiment that I got from my bankers. And as an immediate policy reaction, they typically dropped LVRs by 5%, just as a way to stem the flow and to show, for non-banks, to show their funders they were being responsible. They asked for extra paperwork, often at will, with no framework in place. They just asked for more paperwork and questions as per the previous enhanced due diligence slides, and they biased their existing clients. So that was a trend that we were seeing when coronavirus first hit. Now that we're a few months along since March and April, these policies are more settled. So for commercial lending, we'll share what these policies are, both for owner-occupied properties as well as for owner-occupied properties as well as for investment properties. And what you will find is investment property has been much more impacted. Okay, so for commercial owner-occupied property, the feedback that I'm getting from our bankers is there really is no change in policy at this point in time. And that's because each client, each scenario, each industry, each asset is different, and it's case by case. In other words, a judgmental credit policy applies. So they want to see the deal, evaluate it, know there's a good business standing behind the loan. They will ask the enhanced due diligence questions, but there has been no real change in policy for trading businesses looking to get a loan and a commercial owner-occupied loan. Where the policy changes have really hit is commercial investment property. As I said before, if something goes wrong, often a property investor, as an ultimate last resort, can sell the property and is protected by the equity in that. They and the bank are protected by the equity held in that property. Okay, so let's look at the changes in policy across different asset types. Okay, so for retail and B-grade office, this has been the most severely hit. I mentioned LVR changes of 5% before. LVR changes for office have dropped by 10% for a lot of major bank lenders. So 10% can be a lot of money in a $2 million property. Their servicing requirements, so ICR, which stands for interest times cover. This is a servicing test which commercial banks apply, and it looks at the ratio of your net rent to the interest cost per annum. These ICRs have changed, going from 2 times. So your net rent has to be 2 times interest costs. So you kind of got double the cash flow you need to service the loan, if you will, to now 2.5 times. So they're really requiring you to have a servicing buffer. Industrial, we mentioned that was a favored part of the market. No change in LVRs, but ICRs have also increased. Residual stock. So this is where there are multiple dwellings or a mix of commercial and unit blocks in a unit block development. These are often asset types held by property developers. No change in LVR, but ICRs have dialed up from 1.75 to 2 times. Now, finally, for major banks, accommodation, so motel, hotels, is really out of favor as an investment property. So if you're not the operator, but it's purely investment, I've been told by some bankers no or limited appetite for hotels and motels. Okay, for those numerically inclined, we're going to now look at the impact of these policy changes on your servicing requirements and on the equity you need to put into a deal. Okay, so let's just say you have a really high performing retail asset. It might even be an office, but it's quite high performing. So let's keep it at a $2 million price point. And we noted before that the maximum LVR that a bank could lend before coronavirus was 65%. So if the value of the property is 2 million and the LVR is 65%, then the bank's giving you 1.3 million, which means your equity, now we're excluding transaction costs for the moment, your equity is 700,000, or the deposit you need to put in is 700,000. Now, this property, let's say, earns 10,000 a month on a gross basis. There's 20,000 of costs, and so your net rent for this property is 100,000. This means the yield of the property, the net yield, is 5%. So 100,000 over 2 million is 5%. Now, going to the ICR or the servicing calculation, if you're borrowing 1.3 million at a 3.5% interest rate, the interest per annum is 45,500. And so when you take the net rent and you divide it by the interest, you get a 2.2 times ICR. And so we saw that in prior to coronavirus, policy was at 2 times ICR. Because 2.2 is greater than 2, you have a very comfortably servicing property here. The banks would take this deal any day of the week, at least with old policy. This is how strongly this property would perform. If it's earning $100,000 net rent and a 2 times ICR, this property could actually sustain an interest cost of 50,000 per annum. So this was calculated as 100,000 divided by 2 is 50, which means it could carry an implied debt of 1.43 million. So 1.428 if we take the decimal points in. And this is simply calculated by 50,000 divided by the 3.5% interest rate. And in theory, 1.428 over 2 million is a 71% LVR. Now, what banks do is, even if this property is really strongly servicing, if they have a strict policy, they will cap the LVR. So they're going to take the lower of what you can actually sustain and what their policy is. So in this case, this property would be given 1.3 million regardless. Now, let's look at what would happen given just the change in ICR requirement. So it goes now from 2 to 2.5. This means that with the higher ICR requirement, this property, which still earns 100,000, can carry less debt. So the implied debt that it can carry has dropped from 1.428 to 1.142, and this is now a 57% LVR. So just to share this 1.142. Okay, so firstly, 40,000 was calculated 100,000 minus the 2.5 times requirement, which gives 100,000 divided by the 2.5 times requirement, which gives you 40,000. The implied debt, 40,000 divided by the 3.5% interest rate, which is 1.14, and then the LVR that you can now carry is only 1.14 divided by 2, which is 57%. And of course, I mentioned the banks take the lower. And so even now, if you have this hurdle, if the ICR has changed from 2 to 2.5, but even if you're allowed a 65% LVR, the banks will give you the lower amount. So you're only allowed to borrow if the ICR changed 1.142. Now, this would mean for a borrower that you have an equity call. To keep the loan with the bank or to get the loan with the bank, you would need to contribute another 157,000 to make this deal work. This is a big change, and it would hit a lot of small business owners if they had this requirement. Okay, now that's the ICR change. Knowing this, most clients start failing. This is why banks then drop the LVR requirement. So we're now combining this ICR change with the LVR change. And so for a $2 million property at a 55% LVR, 2 million times 55 is 1.1. The equity you now require is 900,000 to make this deal work. Let's assume that there is no change in the rental yet. With the same rent, but a lower loan amount, sorry, with the same rent and the lower loan amount, meaning you're getting charged less interest because there's less interest because you've dropped the amount that you've borrowed. The ICR now starts working at 2.6, just because the bank has forced you to drop the loan. No change to the amount of debt you can hold. As we said before, 100,000 divided by 2.5 is 40,000. So no change in the amount of debt you hold. But you're now capped by the actual LVR policy. So banks will give you the lower of 55 and 57. Which means actually, if this property was to go to the bank or go to the bank as a purchase or seek refinancing, it's not 157,000. If you change the ICR and the LVR, you would be forced to put in 200,000 to make this property work. So this is how these policies change. These policy changes would impact a real property, but it's actually a lot worse out there, guys. If you walk along retail shopping strips and in the city, it's a lot worse. You actually have buildings, or you have actually shops that don't have any customers or very few customers. So often you'll actually see not only a drop in the rent, sorry, you will see actually valuations coming in low. So 55, you might see a 10% drop in valuation. And so the bank will always lend against the valuation, not the purchase price. So 55 times 1.8 is only 990. You got to put in 1.01. But what if the rent had to drop 20% as well? Instead of 100,000 net rent, it's now earning 80,000, which is a 4% net yield. And this flows all the way through, guys. So you would end up, if the yield changed to 80,000 or 4%, you would have a 2.31 ICR. And if you follow through the maths, this property would really suffer in terms of bank policy. You may have to put up to 385,000 to make the deal work. In most cases, where the loan falls into under 1 million, you would just change types of loans or types of banks. You would either you would probably go to a low doc loan and try and get the loan back up to 1 million to make this deal work in reality. But this just shows, guys, this is going to hurt a lot of commercial property in the marketplace, and it's something to watch out for in the months to come. Okay, guys, thanks to everyone for listening. We're just going to wrap up now. I think we are 5 minutes over time. So just a summary of recommendations. Have a COVID business plan. Make sure you know what you're going to do in this period. Be ready to provide a lender more information, so responding to COVID impact questions, providing more supporting documentation. And definitely, if you think you're going to be in a difficult period, seek some help. Talk to your accountants or your other advisors and defer your loans if you need to. If you need to follow up and contact us, I've set some time aside in my calendar to take any appointments or meetings for business owners. So please drop me a line on my email or Calendly link. And of course, reach out to any member of the team as well. Okay, so that concludes the webinar. If you are short of time, feel free to drop off. But what I'll do is I'll just spend 5-10 minutes going through any questions and answering those. If they're straightforward, I'll answer those now. But if not, I will respond to either everyone or individually a more tailored response. So thank you everyone for joining. Just see if there's any questions. If not, we will finish up the webinar. Okay, and looks like no one had anything. What I'd say is if you do have any questions, feel free to drop me a line and I'll be happy to answer your questions on email. Or give me a call and we can discuss on the phone. All right, and that's our webinar. Thanks everyone for joining our Show Me the Money webinar.